Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, November 1st, 2024. S&P 500 currently sitting at 57.55. I'm David Zarley. I'm here with Ian Hot Dog McMillan. We just got done with Halloween, or Reformation for some. Do you have trick-or-treating?
Yeah. Gotta do it with the kiddos.
What were your kids?
We had, our oldest was a skeleton.
Okay.
And our youngest was Woody from Toy Story.
Those are great choices. That's great.
I
Great
know
time of year.
Yours are out of it for the most part, right?
Yeah, we have rules. Once you turn 13, that's your last year trick-or-treating.
I think that's fair.
Micah went as I don't even know how to describe it, like a blob. He had this blow-up costume. It's got a fan in it. Makes him look like a big round ball. It was
I saw a few of those last night. What's that game that the kids play now?
Oh, yeah, probably.
That one online where you got to find the intruder?
Yeah, that sounds right. That sounds familiar. But then I found out last night that my junior daughter, junior high school, went trick-or-treating. She went as a hot dog.
Okay.
Which we all agree is a great choice. If you're going to choose a food to go as for Halloween. It feels practical. It's long, you can fit in it.
I mean, no one hates hot dogs.
Yeah, I mean, and if someone does, you immediately steer clear, right? Like if someone hates hot dogs, they're probably a communist. So you just don't go to there because you're going to probably get like a potato or something like that for
potato and
bread or like a toothbrush.
That's what they serve at their commune.
Exactly. We all know those places that give out like a toothbrush for Halloween or like a penny. Yeah, or quarter. Here, have a quarter. Crazy. What's the best Halloween candy?
Oh, Tootsie Rolls.
Okay. Yeah.
We had a discussion last night. Growing up, Twizzlers and Tootsie Rolls were, I feel like, kind of ones that I sought out, in my bucket.
Okay.
I don't think Connor got a single Tootsie Roll.
Really?
That's serious. I don't know if they're not a thing anymore. Definitely Twizzlers and all the typical stuff. But I went digging, and I did not find a Tootsie Roll last night. I was going to take it for myself.
I was going to say you were instituting a Halloween tax.
Yeah.
Yeah, no, I get it. I'll have to take a look because I also know they came out with flavored Tootsie Rolls where it's not the chocolate.
Oh yeah, those were always gross.
But they also made the big ones, like the really big Tootsie Rolls, not just the individual tiny ones. They made Tootsie Logs or something like that. Kind of wild. But yeah, it's a great time of year. Weather's cooling off. Leaves are changing. Backyard fires are happening. Kids are having a good time. It's also Reformation. Martin Luther having the original pinned tweet, the 95 Theses. It's a great time.
That's yesterday was kind of rough for the market, though.
Yes, it was. Like yesterday. Well, it's
first time in a while.
Yeah, we had one of the least volatile Octobers in about 50 years until yesterday. All indices were positive until yesterday.
Yeah, best year-to-date returns for any election year since 1936.
Yeah,
it's tough. No October weakness, seasonal weakness, which
until last day,
typically happens.
Well, what's interesting is the month will go down as a negative performance month for S&P 500, the Dow Jones, the NASDAQ 100, and the Russell 2000. What's down more for the month of October?
Then those indices?
Yeah.
Down more,
not equity related.
Bonds.
Yes.
Really?
Treasuries down more. Treasuries, if I can use government treasuries, if you're using TLT or close to down 2% for the month, and if you're using GOVT, government treasuries down 2.4. So that 60-40 portfolio, not really. Do we just need to retire it? I think we just need to retire it. because if bonds aren't going to offset stocks, if you have negative months in stocks and bonds are negative even more, what does it tell you? One day doesn't make a market, but it was negative basically from day 2 onward, day 2 of October, and bonds being down more than stocks, typically an environment that's still risk on.
That's a shame. It's a shame, but not a surprise.
Yeah, not a surprise, correct. There's been a downtrend, and we've talked about new all-time highs in equities, numerous indices, and stocks, and even I don't know why they call them a redheaded stepchild, but even the Russell 2000 not being at new all-time highs. Russell 2000 doesn't look like anything like the drunk uncle government bonds.
Oh,
just bad.
No one wants that. You can pretty much own anything and get away with it in the fixed income. I mean, you can even go. You can go overseas.
Yeah,
being an uptrend. More so emerging market, but yeah, the treasuries, and they continue, and all shapes and sizes, right? Well, not T-bills. T-bills still look fine. You're short term, you're 1 to 3 months.
Short term
looks fine.
But for context, I mean, IWM small caps are 10% away from all-time highs.
But this is what you would expect, right? If you're in a rising rate environment, and I guess Dave and I can sit here and say we think rising rate. I've messed that up for a year.
That's right.
A rising rate environment. I mean, we can sit here, but I do feel like the market continues to say that is correct.
Right.
We don't run into treasuries on, the first sign of if they get sold off of stocks.
Well, even more so,
more so. You took the words right out of my mouth.
I mean, small caps 10% away from all-time highs, and you've got TLT representing long duration treasuries down 45% from its all-time highs. It's time for the industry to say the 60-40 portfolio is dead. Like, I get why it happened. I get why since 1980 through 2020, roughly 40 years, that you had a falling rate environment with rising bond prices, that 60-40 made sense, that TLT or AGG or any of these bond proxies were the offset for your equity portion. It's just no longer the case. It just is not. The downtrend in bonds, the uptrend in rates continues. We've said it on this podcast for well over a year now, to your point, Ian. And all price does is confirm that thesis. Ian's not saying it's a guaranteed rising rate environment. It's a thesis. And you look for the data to confirm or refute that thesis. We're scientists. And all we continue to see is rates,
yeah,
confirm the rising rate thesis. And so no longer is the 60-40 portfolio viable or in the best interest of someone if that 40% is going to get sold off more than equities. It just doesn't make sense. And so, Ian, I want to try something new.
Okay.
A Flashback Friday. Remember those on the radio?
Flashback Friday. Okay.
Okay. What I want to do is play a brief clip from episode 184. This was recorded the day after your birthday. Yep, 184, called The Table is Set. And this was recorded the day after your birthday last year. So you're a year older. You're almost a year older.
A year older.
And
a year wiser.
Yeah. I kind of want to get talking about thesis. I kind of want to get your reaction to this. So we're going to try it.
Okay.
We'll see how it goes. And then we'll go from there. So I'll play this brief clip and then we can respond to it.
Last week was pretty eventful from a market standpoint, as far as some of the meetings that we recorded that you guys might not have known until after close. And a couple of those things would be some breadth for us, right? Breadth being the participation of stocks. We kind of had this capitulation event last week where, the technician might use the term market flush the week before that, and then substantial response in breadth of almost, you can argue, the gun going off for a new marathon race. Now that will be to be determined. We don't predict the future. But any time that you're recording Whaley breadth thrust and a Zweig breadth thrust in the same, we officially got those. We did. Okay.
So 1 year ago,
Wow.
51 weeks ago,
Yeah.
we covered the Whaley breadth thrust and the Zweig breadth thrust. We had a capitulation event. The episode title was Table is Set. And to summarize, in that episode, you talked about how Mr. Market could either party, like the Mr. Market shows up and the table is set. He could either enjoy what was going on and we have everybody participating in the fun, or Mr. Market could flip the table, be super grouchy, and be a party pooper. What are we seeing 1 year out?
Yeah, and I think, right, so, yeah, I mean, I remember it. Obviously, the ETF had just gone to cash because we were below the 200-day, and we got back in. That would have been that Monday the 6th.
Right. 1 week out in the next week. That's called adapting, isn't it?
And you had a 200-day that had started sloping up earlier in the year. I would say you could probably argue April. I'd say more June. So you had that wind, right? How often did we talk about upward sloping 200 days?
Yeah, correct.
You had the breadth thrusts. You had lines in the sand. Obviously, we were not at all-time highs. We wouldn't get there till January. But yeah, I mean, I guess I'm glad we titled the episode what we did. The table was set. The table was like, okay, this could be something now. In hindsight, we looked through the end of March. They were once in a decade, moves, 6-month moves, 5-month moves. I think like the Russell 2000 had like its 6th or 7th strongest rally. I'd have to go back and look at some of the data and tweets. And yeah, so I mean, the table's set. To your point, you don't know what it's going to do, but yeah, you put your chips on the table, and we would have known pretty soon if we were wrong, if it was going to roll over. It was a good setup there. You had the failed breakdown, right? The failed breakdown at 4,200.
Yeah, 4,180. Remember how long we talked about 4,180? And you had highlighted that, the Zweig breadth thrust is a rare animal, but
it is.
Bats 1,000, and here we are 1 year later, S&P 500 up about 33% from that point, batting 1,000 again, 12 months out. So it's about using the data. It's never about knowing what the future is going to be. It's about what the future could be, and then using price to refute or confirm what the future could be. Because quite simply, if you can't be above 4,180 up there, up a Zweig breadth thrust, well, then obviously that thesis is.
We got issues. Yeah, we got some issues in the market.
And so here we're coming off currently one of the least volatile Octobers in 50 years, with the exception of yesterday. And isn't it fascinating that you have two really unique events happen within the month and within a day? And what I mean by that is an October least volatile in the last 50 years, and then yesterday, gapping down, selling off, closing near the lows. You've only had 9 of those over the past 20 years.
Wow.
And you had indices that then had been positive all month, closed negative, with Treasury.
Yeah, we definitely gave back 3 weeks of gains yesterday. That's okay.
And those are markets. And we overcame seasonality and we didn't. Meaning Octobers are notoriously weak and actually an opportunity to buy many times, because the best 6 months is upcoming, November through April, which we talked about in episode 184 as well, are notorious for being a strong period of time.
That is true.
And so,
but what if that's a relationship that changes?
Mm-hmm. And that would be information, and I think you have 2 points with that. One being, if that's a seasonal tendency, and that's not what you see. So if November through April is notoriously strong, especially post-election, and you don't get that, that's tremendous information. But I think you're also highlighting, just like interest rates go in cycles that are bigger than our memory can handle of 40 years, and we're in a new rising rate environment, does that seasonality change? It could.
These are the things I think about.
Yeah, I know.
You're in the yard or in the shower.
Yeah. You're laying in bed. Your wife is wondering, what is he thinking about?
What if May through October becomes the best seasonal period?
It could. Markets are never a guarantee. And that's how you should view seasonality. Seasonality is not a guarantee. It's just an awareness. You know, in Wisconsin, heading into November, you become aware that, winter is upon us. The temperatures are changing. And the precipitation is changing. You're no longer getting rain, you're getting snow. If you don't get that, that's information. And so if we don't get a strong 6 months here, it could be one of two things. It's either the seasonal winds that have shifted completely, to your point about cycles, or this market is much weaker than we thought, and the summer of 2025 will be extremely weak. And the sad news for many, exciting news for us, is we don't know. The hardest words in the English language, maybe besides I'm sorry, or I don't know.
Yeah, definitely one of those things to be aware of. I mean, you can't sit there and say, I'm okay holding stocks, because seasonality should be fine, if we go into a sell-off, or we'll see. Maybe we won't do anything before the election.
Right. I think, next Tuesday is the election. One of the best election year performance-wise for a market that we've seen in quite some time. I know you were highlighting that before we hopped on here. And so do we see from today through next Tuesday some consolidating? I mean, you look at S&P 500 futures, and there's a volume valley or a volume gap that sits between 56.30 and the current level of around 57.60. And so do you see an auctioning process that determines whether any buying that took place above that level is for real? And below that, if we're below 56.30, you might start to question the strength of the uptrend. Are we moving sideways for the next 3 or 4 months?
Yeah, 56.30 would definitely be a little odd.
And, to your point,
wouldn't care for that. Yeah.
Earlier, that could be a cyclical thing, could be a seasonal thing, could also be an extremely healthy thing considering how far and fast we've moved since episode 184 1 year ago.
Could be. I mean, right? We know we're not going to get 22% annualized or 20, whatever we're at, for. We know that that's not what you get every year.
Right.
But glad to capitalize on it. We have lost the rate of trend from the August lows. If I look at the S&P and I connect August, and was that August 5th? Yeah, that was the whole yen thing, Japanese yen. And then we got the September 9th or September 6th. And so we have lost a rate of trend, intermediate term rate of trend. Long-term uptrend still.
Yeah, the uptrend is fine. We have higher highs, higher lows. You got a rising 200-day all over the place. And you talked about annualized returns. Yes, the last 12 months for something like S&P 500, very nice. Yet you look at equal weighted S&P, or you look at small caps. Small caps have a negative annualized rate of return looking back 3 years.
Wow.
And, IWM still being 10% away, and then RSP trying to hold its prior highs. I mean, we're really talking about equal weight S&P 500. So taking all the stocks S&P 500, equally weighting them, being up 7% in 3 years. I don't know. An argument can be made for both cases. Oh yeah, the last 12 months for the S&P 500 has been great, but the last 3 years have not. That's just the reality of the situation. So what else? What else would you like to highlight for our listeners from the past week, month, you name it?
I'm still not big on the gold or gold miner train yet.
Okay.
Get a lot of attention. Relative chart just still, and then I mean gold for sure. I'm not there. I mean, does this sound weird? If I had to buy one today, I would buy gold over gold miners.
Okay.
Which doesn't make me short-term bullish on the space, on the PMs, precious metals. Well, that's silver, gold.
Yeah, what are we seeing out of that relationship?
Just a hot mess. Same spot we've been for 2.5 years, middle of the range. What are the non-hot messes?
The non-hot, well, and that's a great point because I think the non-hot messes are few and far between, and we highlighted that last week. Talking about has there really been a sector that's been leading?
Yeah, and there continues to. I would say there's no broad sector relative chart where if you looked at it, you would say, "Oh my gosh." Now, you pointed this out earlier today. If we were to close here and you made me buy one, I guess communication services based on the relative chart.
Yeah.
I could get behind that.
Yeah.
Maybe we'll see what discretionary does on the back of this Amazon. They had earnings yesterday, right? And that's why looks all good.
No, I think that's a great point. You look at communication services with the two largest components being Google and Facebook. When you look at XLC versus S&P, it's clearing a range to the upside that's been in place since last year, October 23. So we've been 1 year in a range, and we're finally clearing that. And actually, it was a level that we broke down back in February of 22. That communication services is starting to show signs of being productive. But overall, the last 6 months, tech has been weak. Still has work to do. Whereas XLC, if you look at communication services versus XLK, also trying to clear a range that goes back to July of 22. I mean, that's a pretty, almost a 2-year base.
Wow. Yeah.
And do you see those move to the upside? Time will tell. I mean, it's a good start for the way that Google responded to its earnings. Meta didn't have as great as a response. But similar to tech, it's going to be pretty hard to pull down a market if communication services is doing well. And I think another sector worth highlighting is just financials.
Financials hanging in there. When we yesterday, right?
When we look at the month of October being negative for most indices and financials are up 3% for the month, that reeks of strength out of an area that is a risk-on area. Typically, if the economy is weak and things aren't good, you're not seeing financials do what they did in October. And so if financials are going to remain strong in this market environment, and it has work to do on a relative basis. It's not like it's all free and clear. By many measures, whether you're looking at capital markets or regional banks, we're still trying to figure out and work through the price collapse that took place in March of 23 during that mini regional banking crisis. Again, time will tell. But if it were to move higher and be a leader, this is kind of what it would start to look like. And
definitely dug its heels in the ground.
Yep.
And you had regional banks now, worse than they got hit. I mean, he tried to go for year-to-date high. I mean, we did get to intraday year-to-date highs on Wednesday. They've held up well, all things considered. Still technically above a relative 200-day, just kind of floating along, same spot we were at in July.
Well, that's just it. Is what many don't realize is the market doesn't have a monopoly of returns for any one political party. But what you do typically see after an election is the market respond, but it's really about what's happening underneath the surface.
Yeah.
And you start to see strength develop. And that's what I'm most excited about is if we get a definitive electoral college winner and that person can be kept alive, there's going to be segments or sectors or sub-industries that will show themselves. Right now, for the past 6 months, they've just been wavering back and forth, these different areas, rotating, allowing the market to stay up. And that's great. But what we should be paying attention to after the election is what are the things that are moving higher that are like a beach ball that was pushed underwater. That'll be good. I mean, I think all of us are excited for the election to be done. I love voting. Don't get me wrong, but the commercials can stop.
Texts can stop.
Yeah, the vitriol can stop. We need to go about our business and live our lives and serve people. Don't really want to be focused on politics that much. So what else? You touched a little bit on gold. Gold's been strong with the rising
Bitcoin. What about our digital gold?
Yeah.
Friend?
What do you see out of the coins a bit?
They're trying, man. They are. I mean, they are up at all-time highs here, sitting back at 70,000 a day. Yeah, I mean, I think it's held up well. Like, it's definitely a risk-on asset. It really has, in the grand scheme of things, hasn't budged. Relative chart looks good. I think it's got a lot of potential here.
Yeah, I mean, it's basically moved sideways since March of this year. So we're talking about 6 months of consolidation that's taken place right at the highs from November of 21 and April.
Very nice monthly chart. I will say that.
Yeah, I mean, there's definitely very constructive behavior happening out of Bitcoin. I don't think we recorded a new all-time high yet, but we're right on the precipice with a very tight consolidation, to your point, Ian, that's taken place for quite a while here. It will be information, right? What we know about uptrends is that when there's consolidation, the thesis of an ongoing uptrend is only confirmed if that consolidation breaks to the upside. So if we break to the upside, you could see Bitcoin move very quickly that direction, but it's also information if it doesn't. If we're breaking back below, and this is how we use price, right? If we're breaking back below 60,000, 57,000.
Yeah.
That was all distribution that took place the last 6 months. So time will tell. We've got an elevated VIX. We've got a VIX, I think, sitting around 20. And therefore, you're going to have, in theory, larger daily intraday ranges of 1% or more.
Yeah, you're right.
But otherwise, despite yesterday, you're still seeing quality risk on metrics, whether it's growth versus value, or seeing financials take the baton, or stocks over bonds, junk bonds over aggregate bonds. You're still seeing a cooled off credit market. And so it's not like we get to go through markets in a straight line. We're going to have days like yesterday where the market down 1% or 2.
Again, pretty normal. So, 22, 21 on the VIX. Guess seems pretty normal. Recently, for pre-election environment, 2020, we were up in October 2020. Up at 38 on the VIX. We were still coming down from the highs of COVID where we were up in like the 70s and 80s. So that sounds high, but in context of where we were at, where we were coming from, we were on the way down. But so 38, 2016, VIX of 22.
Yep.
2012 VIX of 20, 19-ish 20. 08, you had an elevated VIX. November of 08, we're up in the 70s, but the market did go lower. But there were some things I think that bottomed out in 08. November 08, October, November 08. 04, you had a lower VIX. The 14s, 15s. So, yeah, pretty on par. Obviously, it's a bigger move than golly, for most of the year, right? We floated between 12 and 15. And that's how you get these low volatility uptrends.
Yep. Well, and that'll be an interesting thing to observe, too, is if there is a Trump victory next Tuesday. The narrative going into the 2016 election when he won was the market was going to collapse, and we subsequently recorded the least volatile year on record in 2017. I don't know that we get to expect the same thing for 20.
Yeah, I've thought about that too, Dave, as part of my mowing mind wanderings.
Okay.
Yes, I mean in 2016, the initial reaction was low, right? Weren't futures down, like Dow futures down like 1,100 points at one point?
Yeah, it was down, in election night, down pretty big.
And then I feel like when I woke up, they were way up. Futures were way up. And yeah, just kind of never looked back.
Well, and you know what I find interesting?
But I don't think that's going to happen this time.
Yeah, we'll only know through time, and that's the hard part for people. Is many people listen to financial media because they want to feel like they're in the know, because that gives them, I'll call it, a false sense of confidence. Interesting chart that I saw this week, shared by a fellow charter market technician, Larry Thompson, was about Bitcoin.
Yes,
and how regardless, whether you're looking at 2016 election, 2020 election, or this current election, is typically when you see the cycle or the seasonality of an intense uptrend accelerate for Bitcoin. And so above this 70,000 level of Bitcoin, would we really get to be surprised that the next year Bitcoin's higher post-election? Probably not.
No. Man, wouldn't that be? Yeah, I thought that was a fascinating chart when he shared it. I had no idea. I'd never seen that before.
Right. Well, we had yesterday, we got this, we'll call it a gap, and we can use S&P 500. I think that's fair. We have a gap that's sitting at 57.75. It'll be telling if we can get back above that level and when we do. There's nothing wrong with a pullback. We had a almost 10% pullback in July. Wasn't fun, but that's markets. You typically won't get one of those a year. And so it's markets don't move in a straight line. So are we getting a 5%, 7% move pulling back in? That's also extremely healthy. Like, you don't want to see S&P 500 ripping through and being 12% away from a 200-day moving average.
Yes, 100% agree with that.
Like any time that you're getting in the single-digit percentiles of distance from a previous average, that's where you typically see correction and larger corrections or really long sideways moves.
Mm-hmm.
And let's be honest, we've had a great move since episode 184, since November of last year. It's been a wonderful ride.
Don't take it for granted.
Right. Enjoy that it happened. Could this be the beginning of a further correction to the downside? Maybe. We know that we have a volume pocket sitting at, 56.50 all the way through this 5,700 level that we're at. It'll be interesting to see what the auction process looks like right there, whether buyers are going to step in. Time will tell. We don't have small caps yet at all-time highs. There's room to run there. And interestingly enough, it's small cap financials that are leading small caps. That's also risk on behavior.
You know what? Go ahead.
No, go ahead.
Not to be negative about things that are a little weird.
Yeah, no, let's do the refute.
EFA.
Okay.
I mean, it's an uptrend, sitting on its 200 day. I mean, a kind of a failed breakout.
Yep.
Very weak. And foreign stocks just went to new relative lows again.
Yeah, across the board. Swiss stocks,
so bad.
Stocks from Denmark. There's so much across the board internationally. And again, this goes back to that 60-40 portfolio construction. Our industry tends to say, hey, let's buy and hold a slice of international no matter what. And we're here to say that that's garbage. I know garbage is a hot topic these days, but
I'm garbage.
Yeah, I know. I am also garbage, but that's okay. My garbage don't stink. Anyway, the broad brush of international is missing the analysis of the bristles of the brush, meaning things like Argentina. So there are things that internationally that are fine.
How about that? Argentina, man. Good for them.
Yeah, don't cry for them. The fact that we can analyze markets using charts, using ratios, slicing up the loaf of bread in multiple ways is such a blessing, because how many advisors out there go and allocate to a broad stroke? I'm just going to own VEU, or I'm going to have some international exposure here. It's always going to be held in there. And it's just been this dog of a underperformer. Why not use ratio analysis and relative strength analysis to understand, okay, if I have to own an international, maybe I'll own these pieces because they have relative strength. We don't have to own all these things. And in the end, it's an opportunity analysis. Are you identifying opportunity? Are you using ratio analysis to understand, oh yeah, if we're going to own something international, probably should be something like Argentina or Singapore. But to your point, that's not the case across most international stocks. It just isn't. And your point about EFA, or I think it was EFA or UFN.
Yep.
Yeah, EFA, I mean, struggling with this $81 level that goes all the way back to 2007. It's a huge level, a behavioral mile marker in the market to try and clear, and remains in a downtrend. You look at, EFA versus S&P, fresh relative lows. Why be involved with that when you have other places for opportunity? I mean, shoot, even gold versus EFA, fresh highs that we haven't seen for 4 years. We'll see. What else, Ian? What else would our listeners appreciate getting information on or insights on that you'd like to highlight before we wrap it up?
I think fixed income's still fine. Spreads are fine.
And that's risk on, right? You're talking about relationship.
Risk on, I think it's, leads to an intermediate and long-term risk on view. Stocks get hit the next week or so. I don't think that really changes anything about the big picture. Fine.
The November through January period is typically up around 77% of the time. Average return around 4.5%. NASDAQ, same thing. We look back 75 years, averaging up about 6%. It's up about 75% of the time. It's the November through January. It's typically the best 3 months, even in the 6-month period that we're heading into. Tongue in cheek, maybe yesterday was about setting that up. That we have a sell-off yesterday to set up a very, very positive November through January.
We could.
And
I like that.
When we look at length of bull markets, right, the average duration of a bull market, again, the average being one of the least frequent things that happens, actually, 61 months. And so any which way you want to draw it, if you want to say that you knew exactly when the bottom was in October of 22, that's fine. We're now at 2 years. We're at 48 months. Or I'm sorry, no, that's 24 months. Or if you want to say getting about 4,100 or getting about 4,800 was the beginning of the bull market, we're even younger. So if your average duration is 60 plus months for a bull market, there's still room to run if it wants to. Again, time will tell. I want to highlight Ian, talking about breadth thrusts and momentum and relative strength, the sport of this podcast, the Adaptive Select ETF, which is listed on the New York Stock Exchange under ticker ADPV, which helps investors access two of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. As always, investing involves risk, including possible loss of principal, distributed by Quasar Distributors, LLC. Anything else, Ian, before we wrap this one up?
I don't. Next time we talk to our listeners, we'll be on the other side.
Yep.
We'll be on the other side of whatever happens on Tuesday and whatever the market's at least initial reactions are. We'll discuss them.
Exactly.
I'm sure that there will be a lot, or maybe there won't be. What if we got,
Yeah, we can move sideways. Yeah, we could consolidate more. Nothing wrong with that. And I know, Ian, you and I want to give a shout out to Dan Gorkuber.
Yes.
He served us and our clients for the past 2.5 years. That chapter in his life is ending. He's looking to take on some new tangible adventures outside of markets and finance, and we wish him all the best. Super talented individual, did a lot for us, and we just want to say thank you to Dan for his dedication to the team, to Price, and to our clients. So if you're listening to this, Dan, shout out to you. We appreciate you, and Lord's blessings on your future.
Have a great weekend, everyone.